Okay, in other words, if the stock's way down over 5 years, that's a positive sign. So 1 year bad momentum is pretty much the worst place you could look. 5 year is one of the best places you can look. I don't look at either. And there's still plenty of bargains. I mean,
You shameless cloner. Want to track portfolios of famous value investors like Warren Buffett? See their buys and sells, current and historical holdings? Just visit valueinvesting.guru. It is valueinvesting.guru. Link in the description.
so anyway.
Do you still, this is to Warren Buffett, and your agreement, do you still think that not looking at a stock price is an important way of looking at the valuation for a business? There was one line that Buffett's writing that he doesn't care where the stock trades, he's just looking at the book. So it's still important, and how does that relate to mitigating risk?
Well, he must have been referring to the fact that he's analyzing a business, so the stock price is not relevant. If the stock happens to be cheap relative to his valuation, then he would play. Also, over time, there's a great learning experience. You know, one of the other questions was, well, how do you learn an industry or whatever? Sometimes you find a company that looks cheap, and then you have to sort of learn the industry. You might not learn it well enough to feel confident, but you'll have to learn the industry. And even if the stock didn't end up being cheap, in other words, you look at a lot of things, right? You swing at 1 out of 20 pitches. Well, how do you even analyze the pitch? There's different levels of research that you would do to get there. If it continues to look interesting as you're going along, you keep working on it. At the end of the day, when you're doing your papers, you might pick something that looked like, here's my thesis. And I don't know what percentage, but at least 80% of the time, it's not going to be as cheap, or there's going to be some issues, or not going to understand it well enough, or whatever it is, probably a lot more than 80% of the time. So your write-up will be, this is the valuation work I did. I thought it was going to be cheap for these reasons. It turned out it wasn't. Or it turns out my confidence level wasn't high enough, and this was the closest I could come up to the valuation, but I wasn't sure of these things, or whatever it might be. And that happens, but that's a learning experience. You learn that industry, and if that industry gets totally whacked at some point, you now have a basis to go evaluate it, and you're a little ahead of the game because you understand the industry a little better. So I think that's what Buffett's really referring to. He can only invest in, you know, if he looks at his value lines, which is what he looks at, right? Everyone know what a value line is? You know, so it's a little, you know, they put out little pages on each thing. And Buffett, by this time, after many years, he can only invest in, you know, 500 to 1,000 companies at most, and, you know, that are big enough for him to invest in. And over time, he's gotten to know them. So now you just look for companies that are out of favor for a particular reason, or have taken a hit in the short term. You've already done a lot of your research. You can act a little more quickly. You can act with a little more understanding. And I think so it always pays to do that research. And he's happy to evaluate a company and not worry about price, because at some point it may come to him. The price may come to him, and I think that's why, you know, it's valuable. And I think we've found some of our investments looking at one thing and then finding, hey, this company in the same industry is even cheaper or even better, you know, and while we were doing our comparison. And so you might like the industry. In other words, the whole industry may be cheap, but maybe you find even a better play by doing research on one of the companies that you originally found cheap. We'll also spend some time going through some stock screens. They don't have to be particularly sophisticated, but there are different ways to search for cash-rich companies, or low PEs, or high returns on capital with low PEs, or just sifting through things. Or even, you can even look, some people look at this, and actually if you look at the What Works on Wall Street book, a lot of my friends still look at the new low list, okay? And if you looked at the statistics, that's the worst place to look on a momentum basis, the worst place to look for stocks. And I don't use momentum in anything that I do, but the statistics say 1 year momentum is very important for, if it's good momentum, that's good for the stock. If it's bad momentum, that's bad for the stock. But 5 year bad momentum, okay, in other words, if the stock's way down over 5 years, that's a positive sign. So 1 year bad momentum is pretty much the worst place you could look. 5 year is one of the best places you can look. I don't look at either. And there's still plenty of bargains. I mean, if you're picking and choosing, a screen doesn't even have to be a good screen, but it could pick up a few things that you wouldn't have found otherwise, as long as you're doing the research afterwards. It's just a new list to start analyzing things. And we'll go through a bunch of those, and I'll give you some good screening products to use.